Despite a slight decline, the US dollar remains near its highest level in over 5 months, primarily supported by Fed Chairman Jerome Powell, who stated on Tuesday that persistent inflation and the ongoing strength of the US economy imply that tight monetary policies will need a longer runway to be effective. Futures markets have adjusted expectations, now forecasting only a 40 basis point decrease in interest rates for the year. Amidst these conditions, the dollar continues its dominance in the currency race. Will upcoming data reshuffle market standings by week's end? Stay tuned to this economic calendar update. It's shaping up to be a relatively quiet week's end, with a few significant macroeconomic reports, but a substantial lineup of central bank speakers. Traders would be well to pay attention to these talks as they plan their strategies. And this Thursday, the spotlight turns to Australia's labour market. The Australian dollar, which saw a minor boost to 0.64 on a Wednesday, lingers near 5 months low. Markets bets are currently placed on the Reserve Bank of Australia starting rate cuts later this year, although robust employment figures and climbing consumer prices could alter this trajectory. In February, Australia's unemployment unexpectedly fell from 4.1 to 3.7%. outperforming the market's prediction of 4%. Employment figures were equally strong, with a rise of 116.5, reaching a record 14.27 million, far surpassing the consensus forecast of a 40,000 increase. Analysts are now bracing for the unemployment rate to tick up to 3.9%, with only a modest gain of 7,200 in employment expected. If data aligns with the projections, it would confirm the Reserve Bank of Australia's expectations of a softening job market and an uptick in unemployment to 4.2% by June. Under these circumstances, the Aussie might not see significant price movement. However, should employment figures surge again and unemployment fall well below expectations, the Australian dollar could see an uptick. Also, on Thursday, in the United States session, the latest figures for unemployment benefits and secondary housing market sales for March and will be released. In February, sales reached an annual peak amid improving inventory levels, surging 9.5% to 4.38 million units, the highest since February 2023. Analysts now anticipate a decline to 4.2 million. Given the positive economic reports, it's unlikely the Fed will start cutting rates before June. The housing market, which has been under pressure from aggressive monetary tightening, might show signs of adjustment as buyers adapt to higher rates. If the housing data meets expectations, the dollar is likely to remain stable. However, if the figures exceed forecasts, the US dollar could receive a short-term boost. Friday morning will be critical for the yen, which is already under strain, having recently hit a 34-year low of 154 against the dollar. The upcoming release of Japan's national core CPI should provide much-needed support. In February, the annual inflation rate in Japan increased to 2.8% from 2.2%, marking the first acceleration in 4 months and hitting the highest rate since November of the previous year. The core inflation rate also rose to a 4-month high of 2.8% from 2% in January, surpassing the central bank's target of 2%. Expectations are set for a slight easing of inflation to 2.7%, and these figures are pivotal as the central bank has repeatedly emphasized its intention to adjust rates based on a progress towards achieving a stable 2% inflation rate. Market participants are also keenly awaiting the Bank of Japan's quarterly price growth forecast as at its April 25-26 policy meeting focus on potential rate hikes. Many expect the addition could come by July or in the fourth quarter. If inflation unexpectedly surges again, it could increase the likelihood of a rate hike, potentially bolstering the yen. Conversely, if inflation pressures wane, the yen could weaken further. In European markets, traders will assess the latest data on retail sales in the United Kingdom. Despite inflation slowing and potential interest rate cuts, British retail sales remained stable in February, mirroring growing consumer confidence about their financial future. Markets expect a modest 0.3% increase in retail sales. Stronger than expected results could signal that the economy is rebounding from last year's mild recession. Analysts had anticipated a further recovery in retail activity as inflation continued its downward trajectory, although the latest report showed a drop in the UK's inflation rate to 3.2% in March, slightly below the 3.1% forecast. A robust retail sales figure could lend support to the sterling, whereas a decline could weaken the currency, which is already near 5-month low. This review offers a snapshot of key economic indicators that could influence market dynamics in the coming days. Stay informed and place your trades wisely. Wishing all traders success and looking forward to our next market update. See you!